Border tensions and mixed earnings keep stock prices ranged. Industrials and financials eke out gains, while FMCG, healthcare and auto drag. Mid-caps fare better.
Dabur posts a weak quarter as sales stagnate on weak showing by the beverages and healthcare segments, compounded with margin pressure due to rising input costs, a delayed winter and urban slowdown hurt.
Voltas and Blue Star report a weak quarter as household air conditioner demand cools. Voltas also suffers losses in its projects vertical and loses market share in air conditioning units.
Donald Trump tweets he will announce a trade deal tomorrow with a big, highly respected country. Reports suggest it is the UK, and this will offer relief to exporting automakers like JLR, Tata Motors. Stock perks up. We have flashes from the UK PM spokesperson at the bottom of your screen. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Ekta Batra. It is a day of consolidation that we're seeing in the markets. It's actually been a week of consolidation as well. If you look at the Nifty high and low, it's been meandering around that 24,250 at the lower level to 24,450 at the higher level. Right now, right in the middle of the range, 24,400 is where the Nifty is, ahead of weekly options expiry. The good part, broader market is doing a lot better.
Hi, Mangalam. Yes, absolutely. In fact, the broader markets are doing a lot better, not only today, but for the entire week. They've done better at current reckoning. So the mid-cap index, which is up around 0.3% today, has gained around 1.5% on a week-to-date basis. Compare this to the Nifty, which is absolutely flat today and up around 0.2% on a week-to-date basis at current reckoning. So yes, definitely much better for the broader markets. Let's see whether it sustains, considering the amount of variables that we are currently reckoning with in terms of the markets. For the advanced decline ratio, that too is positive, so that stands out at around 2:1. Overall, markets looking good. Maybe Tata Motors would be in focus on the back of those flashes with regards to the UK trade deal. So maybe the flashes should come back on for you. That'll be one of the key triggers to watch out for today.
Take that point, Ekta, entirely. We're also having, a bunch of earnings to track. We have L&T and Titan from the Nifty pack, and then we have, Biocon as well. We have Pilite, we have Britannia. The recent, the company that was recently excluded from the Nifty reports its first quarterly earnings, so we'll watch out for all of that. Speaking about earnings, we do have Wonderla Holidays, which is under a wee bit of pressure after weak set of numbers coming in from the fourth quarter for the company, down about 1.5%. There is a drop in footfalls for the third consecutive year. We're joined by the Managing Director, Arun Chittilapalli, to discuss the company's performance for the quarter gone by. Arun, usually we speak about business looking a lot better, but this is seasonally a weaker quarter. You don't see a lot of action in the fourth quarter as much as you'd see in the first quarter or the third quarter because of the holidays, etc. But what really stands out is that in the last 3 years, your footfalls have actually come down. Q4 FY23, footfalls were 8 lakh. Last year was close to 7 lakh and now 6.8. Even for the full year, if you look at it, 33 lakhs has turned into 32.5 and FY25 is 30. This despite you adding another park. So we're just trying to understand what exactly is happening when it comes to footfalls. Why aren't people just going out to these parks? And what are you doing for them to go out of these go out of their houses to the parks?
Thank you, Mangalam, for having me on the show as usual. Pleasure talking to you. Yeah, so I think for us, Q4 is not a very strong quarter, so we don't get too much footfalls. There are not too many levers for us to play with. So in terms of footfalls, we did see a decline in footfalls in our existing parks, mainly because of Ramadan. I think that is the main outlier this year compared to last year. So because of changing seasons, we do see sometimes footfalls moving between quarters. So we did lose a little bit of footfalls because of that. Otherwise, I think it's been pretty good. I mean, like I said, we were not expecting great numbers in the last financial year. And this year, I mean, the reason why we had flat footfalls is because Bhubaneswar also contributed a little bit of footfalls. Otherwise, we would have seen, I think, about 8 to 10% decline. In terms of revenues also, I think ARPUs also were not very strong for the quarter because this is, again, like I said, a weaker quarter for us. We're not expecting growth in footfalls. I think I had spoken to you last quarter as well and said that, Q4, we're not expecting too much. So that kind of continues.
Okay. All right. Well, the trend is quite obvious. If you look at it, even in terms of FY23, FY24, FY25, there is a trend of declining footfalls despite maybe new parks coming on board. So in that context, what is the company doing in order to probably change that trend fundamentally? Are you maybe innovating a little bit? Is there something in terms of the demand which is not working?
Our new park is, officially opened only from September 2024. So it's still very new for us, and it's also a new market. So I think it takes a little bit of time for a new park to kind of settle in. Sometimes it settles in very quickly, which if it's like a South Indian market, but this is not. This is in the eastern side of the country, so we still have to build a little bit of our brand. And again, not going into season, this is a new category we are trying to build in a new geography. So we can expect some delays in terms of ramp up of footfall for Bhubaneswar. But I think we are hopeful in this financial year. I think we will see better numbers. We are already seeing that happening in the
But I'm not talking about the new parks particularly. I'm talking about maybe a fundamental change in the business model, which you probably need to consider.
Not really. I think what we saw in FY23 is extraordinarily high footfall that we got post-COVID. And then obviously growing on top of that is difficult for especially our older parks, because we don't have that much additional footfall that we can, kind of accommodate in our parks, which are already, if you're running full, then there's only so much that we can add on top of it. So I think we did see softening of footfalls in FY24 and a little bit more in FY25, but we kind of knew that would happen. And so what we did in FY24 and 25 is we increased our ARPUs. FY25 especially was bad for us, mostly because our summer didn't fire that much last year. But I think this year, because summer contributes disproportionately high to our top line and bottom line. So I think summer quarter for us is very, very crucial. And it didn't happen last year. So I think that is one of the reasons. I think other than that, we are not really worried about our footfalls in terms of, and our older parks are, already, most of them are more than 10 years old, except Hyderabad. So I don't see footfall growth that much. Like I said before, there's not that much scope for footfall growth, except in some quarters. If we had lost footfalls, we can try and claw that back. And then, of course, adding new rides and attractions, which we are also doing, and also marketing and other methods to improve ARPU, which we have been doing. So we are not really worried about that in terms of business model or anything, but this kind of business is subject to, any kind of external shocks or weather issues that can, play a role in terms of footfalls, especially in Q1.
Right.
But I think this year, I think it should be better, is what we are feeling.
I'll tell you a couple of things while we speak about your business model. Arun, the role that operating leverage plays in a business like yours. FY22 obviously was a recovery year from COVID. Your revenues were 128 crores, but the EBITDA was 20 crores. The year after that, FY23, which you say was a record year, revenues jumped to 429 crores and EBITDA went all the way up to 211 crores. FY24 as well, mild jump in revenues led to a disproportionate jump in EBITDA. On the way down, that works as well. Because footfalls aren't growing or maybe they're declining, as a result of which, the impact on EBITDA is a lot more. And this coupled with the fact that you have another park. So that meant that your FY25 margins fell from 47% to 32%. Even the fourth quarter, your margins fell from 35% to 20%, seasonality aside. So I just wanted to know what your prognosis on footfall growth for the next year is. Are you looking at crossing the FY23 level of 33 lakh? Yes, can you hear me?
Yeah. Sorry, I lost you for a few seconds. No, I think EBITDA decline has happened in this year mainly because we are also preparing to launch another new park in Chennai. So we have added, in terms of adding people to the roles, we've done that. We've also spent disproportionately high on advertising and marketing in this last year because of our new park in Bhubaneswar, and that will continue. So I think EBITDA decline is expected, and also we also have some ESOP charges that have come into this year. For the first time, we've done that for our employees as a retention strategy. So I think some of these things were expected. We were not really expecting EBITDA to grow when we have new projects in the pipeline and new projects being opened.
What's your prognosis for footfalls for FY26? Do you cross the FY23 mark of 33 lakh?
We are hoping that it will, because we have Bhubaneswar. Hopefully, that will fire this financial year and give us at least a 3 lakh kind of footfall. That's what we are hoping from Bhubaneswar this year, and we should be able to turn EBITDA positive for Bhubaneswar. If that happens, obviously we will see a growth in footfalls. But we are also expecting growth in footfalls in our existing markets like Bangalore and Cochin, which had seen decline. Hyderabad has been holding strong, so we are not. I think it should also continue to grow a little bit footfalls, but I think we are expecting more from Bangalore and Cochin for this financial year.
So what would your margins look like, considering that you have so many variables in this year?
It will be hard for me to predict margins, but definitely margins will be hopefully better than what we did in FY25, maybe slightly better, or maybe flattish for this financial year, because we do have another large project that will be opening by December in Chennai. So we can expect some margin erosion, especially in that Q3 quarter.
What about the overall revenue? You say 3 lakh coming in from, footfalls coming in from Bhubaneswar. So that makes your footfall growth target at least a double digit for FY26. What about revenues?
So we will have footfall growth for definitely. We will see footfall growth in FY26. In terms of revenues, also obviously proportionately we will see revenue growth. Maybe not to the same extent as footfall growth, because new park we obviously will do higher discounts and things like that. It's hard to again put a number on it, but we are expecting marginal growth in footfalls in our existing parks, 3 lakh kind of footfalls from Bhubaneswar, and then of course. In Q4 of FY26, we will have Chennai coming on stream as well.
So with all things considered, 8 to 10% is a fair estimate, I would suppose, because 10% footfall growth because of Bhubaneswar, some coming in from Chennai, you have marginal coming in from your original, and maybe some discounting in realizations because of them being new parks. So 8 to 10 is a reasonable estimate, right?
Between 5 to 10% is, I would say conservatively, between 5 and 10% is what we would think, for sure.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Wonderla. There is a little bit of caution in terms of maybe guidance going into FY26, but nonetheless, that's the stock. The stock should come up for you. But we need to take a break. As we do that, here is some good news for our viewers. India Business News Leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen. Welcome back. You're still tuned in to Halftime Report on CNBC TV18. Let's get talking about numbers then. Coal India is another stock in focus. The company reported its fourth quarter numbers, which came in better than analyst expectations. Nigel is here to tell us more about the stock.
Well, that's right. Coal India's numbers actually were better than what the street was working with. What gives it comfort is actually valuations, and the cash in the books is close to around 15% of its current market cap. Let's run you through the top numbers, though. The revenue, the EBITDA, as well as the profitability, all of them were better than what the street was working with. The reason that the top line beat estimates is because the realizations actually were better, and also e-auction, well, it contributed a larger chunk to the total pie of volumes in comparison to what it was in the previous quarter. So because of that, that's what helped the top line. The EBITDA performance was better because of a couple of more factors. One is that the employee cost itself was relatively lower on a year-on-year basis. It was down by close to around 10%, and also realizations were better. But you'll say the PAT number looked much better. That's because of the other income. That, in fact, was boosted up by a one-time income out there. So that explains why the big beat came on the PAT. But for Coal India, we look at the FSA sales, and then we look at the e-auction sales. And the FSA sales volumes come up in the screen, no big growth out there. However, the realizations were a little bit better, which was a positive surprise. Even on the e-auction front, well, the volumes were a little bit lower because, remember, captive mines are ramping up. So that's why Coal India is losing its dominance to a wee bit. So because of that, we have seen that volumes didn't really pick up, but the realizations did pretty okay. And as a percentage of its total sales mix, you had e-auction volumes that contributed close to 11% of the mix. That compares with around 10% in Q3 FY25. Besides the operational performance, a couple of other factors that worked for them. They pay out good dividends. So 5 rupees dividend was paid out yet again. And also for the year, that number moved to around 26 rupees. And also the balance sheet is in good shape because the receivables came down by more than 1,000 crores or thereabouts. So put all together, Coal India has valuation comfort, and in fact, the past quarter's numbers look better than what the street was working with. Back to you.
Thanks a lot, Nigel. That's about Coal India. Let's move on. HUDCO dispersals in fourth quarter have been weak, but loan growth is strong, aided by stable asset quality. Earlier today, we caught up with the management on the fourth quarter earnings. The stock has moved to the high point of trade. Sanjay Kulshrestha, who's the CMD of the company, says they expect the net interest margin to tend in the 3.3% range itself, with strong growth on AUM. Listen in.
So NIMs, we are continually improving, and now we are at 3.22. And as I had already stated, we generally work on the quality of the assets. So we will be able to maintain around 3.25 to 3.3% of the NIMs. But at the same time, we will not compromise on the asset quality. So you may have seen our presentation that we are cutting down our NPA levels. Efforts are being made to resolve entire stress assets, and with another commitment that there will not be any new NPA in the company. We had stated that we are poised to become 1.5 lakh crores company loan book by FY26, and now we are presently at around 1.25. So I am very sure that we will be achieving this 1.5 lakh crore. I think we are continually working on enhancing disbursement, and not only enhancing the disbursement, we are actually distributing our disbursement in Q1, Q2, Q3, and Q4, so that the income will improve the bottom line in that particular financial year only. So last year we had disbursed around 40,000 crores. So our internal target is between 50 to 55,000 crores.
Right, moving away from earnings that have been reported to earnings that are likely to come today. Biocon is one of them. Ekta, what to expect?
Well, for Biocon, we are expecting the revenue to grow around 5 to 6 odd percent. Margins are seen at around 22 odd percent, 22 to 23 odd percent, and the profit after tax is expected to grow over around 12 odd percent this quarter. Now, in terms of the biologics business, it is expected to be impacted by limited contribution from new launches as well as price erosion within the entire space. So, for example, trastuzumab, pegfilgrastim, the market share in a couple of these will be something which will be watched for. For the generics business, again, pricing pressure is a key component there. So, it is probably expected to be sluggish, and it was sluggish last quarter. So, whether or not it improves. Syngene, we already know that the FY26 guidance disappointed for Syngene, where the revenue growth is seen in mid-single digits versus estimates of around 15 odd percent. Now, in terms of commentary, adalimumab as well as the launch of one of their other biosimilars will be watched for Biocon closely, as well as the liraglutide opportunity. It is a weight loss molecule. And, the kind of opportunity that they probably see in the UK as well as the US markets for it, considering that there are many advanced molecules which are coming into the market as well. Now, separately, the company has also approved raising of around 4,500 crores in terms of funds. So any kind of details on that would be something that would be closely watched. So that's on Biocon. That will be out post-market, so we'll be reacting tomorrow morning to its numbers. We'll take a short break. Aditya Agarwal will join in with his trading call. Stay tuned.
Welcome back. Virtually unchanged for the index from the 24,400 mark for the Nifty, despite the fact that a lot of these stocks are doing well. So L&T has moved to the high point of trade. Infosys and TCS are picking up. So the IT stocks are, now waking up from their lows. And we have some traction seen on BEL. Pull up the intraday chart of BEL. That's moved to the high point of trade. For most part of today, it was in the red and now has spiked towards, that 313, 314 rupee mark after having been flat for the most part today. If you look at the FNO pack, you have the Nifty Bank, which is, Nifty Bank is slightly outperforming in today's trading session. The Nifty is flat. The mid-cap index does well. Today's day's high on the Nifty is very close to yesterday's day's high, which is 24,449, which was on May 7th. And today so far has been 24,447. And the Nifty traded range has been very narrow. Over the last few trading sessions, if you look at it, between 150 to 200 points, the one trade day where it did about 350 points. But then again, on a base of 24,000, just about 1.5%. And today's range so far has just been 74 points, which is 0.25% when it comes to the range. So it's narrowing. It's narrowing with declining volatility. So if you look at the India VIX, that from yesterday has fallen further, now below that 18 mark, around that 18.5 mark itself, and advancing market breadth. So you have more number of stocks which are doing well than the number of stocks which are doing down. All these are signs of a good market. But right now, for expiry, the street doesn't expect any more movement from this beyond this range. The 24,400 call has a premium of 10 rupees. This is the one that expires today. And you look at the 24,400 put, that has a premium of 11 rupees. All of 20 points is what the street is expecting in terms of a range, which is 24,380 to 24,420. But if it were to go lower, then maybe the 24,350 put comes into play as well. There has been some traction there too. Looking at Titan, the stocks moved to the high point of trade ahead of numbers. A lot of long positions added. Let's see whether there's an announcement of a management change coming by along with numbers or not. That is something I'll be watching out for closely, Ekta.
Okay, all right. So those are a couple of stocks, and we will be discussing FMCG in greater detail as the show goes on. As of now, let's talk about the technicals. Aditya Agarwal joins in to discuss what he's tracking this afternoon. Aditya, hi, welcome to the show. Well, it's definitely a tight range, like Mangala mentioned, in terms of the markets. Even the mid-cap index is just about biding time at this point in time. Obviously, the markets are waiting by for a lot more information, one from the border and two, obviously, from the UK, US trade talks details. But overall, what's your sense in terms of the markets?
Hi, Mangalam. Thanks for having the show. Good afternoon to both of you. I think it's more of a consolidation, as Mangalam pointed out at the start of the show. It's going to be like that, I think, for the rest of the trading session, at least for the Nifty. Today's the expiry day. I don't see too much of a volatility picking up in the market. Also look at VIX. It's cooled below the levels of 19, which was trading above the level of 19 in trade yesterday. So I think more or less it should be in that tight range between 24,600 on the upside to about 24,200 on the downside. I don't see too much of a volatility picking up in the markets, even as we move closer to the towards the end of the trading session. And same holds true for Bank Nifty as well. I think 55,000 on the upside to about 54,500 on the downside. This is the zone in which Bank Nifty is expected to oscillate. Between this, I think today is the trading day when broader markets can outperform. So the mid cap and the small cap end of the market looks better to me. There is stock specific and sector specific activity which is likely to pick up and continue. And IT is one of them, which I think has a lot of room on the upside. So one can look at large and mid cap IT stocks. That is where I think you can actually have money making opportunity. Just leave the indices aside, I think. So it's not going to move too much in trade today.
All right, so let's get stock specific. What do you like?
So I've got a couple of buy recommendations. One has to be from the IT space, Mangalam, because I think IT has much more room on the upside. So HCL Tech is looking very interesting to me at current levels. Can be bought for a target of 1,700 on the upside with the stop loss at 1,550 on the downside. The second stock is a DMart. Stock did witness a bit of a correction. It has taken support at a very key trend line, and from there it's bouncing back. So the risk to reward is in extremely favor of going long in DMart at current levels. So with the stop loss at 39.50, I would look to go long for a target of 4,300 on the upside. So DMart and HCL Tech both are on my radar and think can be bought at current levels.
Okay, all right, Aditya, we're going to leave it on that note. Thanks very much for joining in. That is the call coming in on the technicals. We'll take a short break, but up next, we'll talk about FMCG. We have Abneesh Roy, Executive Director at Nuvama Institutional Equities, joining in.
We have a bunch of consumer stocks on our radar today. Not only are we seeing reactions coming in from Dabur, yesterday there was the analyst meet of Godrej Consumer. We have United Breweries post markets yesterday. And now today we have earnings coming in from the likes of Titan, we have Britannia, we have Pilite, we have Asian Paints along with Kalyan Jewellers reporting their numbers too. So let's get in an entire lowdown on the consumption space. We have Abneesh joining in from Nuvama. Abneesh, you've heard from a lot of companies that have reported their numbers so far, management commentaries. While from a texture standpoint, it's not very different from what it was in the third quarter, there are signs of improvement, at least if not in the first quarter, second quarter onwards, both volume pickup and sequential improvements in margins as well. Would that be a correct assessment?
I will agree partly to it. So thanks for having me. So if you see, Marico and Tata Consumer did see improvement versus the previous quarter. Marico with 7% volume growth. Tata Consumer gave the overall volume growth for India for the first time. 6%, not a good, bad number at all. So yes, from a outlook perspective, I think most consumer companies have said that in FY26, from a demand side, things are looking better. And from a raw material side, we'll have to monitor. Yes, crude oil is looking soft, but definitely a lot of other raw material like tea, palm oil, copra, still good news is awaited. Yeah, from a Q2 perspective, I think the improvement could further happen on the urban demand side. So in urban, if you see, results are awaited for more consumer companies. Currently, there is a challenge. So we have seen discretionary demand, QSR, apparel, etc. In FMCG also, urban demand is a challenge. So yes, from a Q2 perspective, urban demand, there could be some improvement. Food inflation is soft. We have seen interest rate cuts twice happen. We have seen also the tax rebate, for example. So yes, rural is doing well. Urban, there's still the challenges there.
Okay, rural is doing well. Urban, there are still some challenges. If you had to just narrow down, Abneesh, and say talk about the domestic volume growth expectations for a Dabur going into next quarter, what would it be, and what would the trend be according to you in FY26 as well?
Sure, I think giving out Q1 is too early. Currently, we are just navigating halfway into the Q4 results. So I will say that it's a bit early. But in case of Dabur, clearly the base is quite favorable. Yesterday in the call, they have addressed on the FY26 outlook. They believe that high single to low double-digit kind of a sales growth is possible. And my sense is volume growth should be also pretty close to that if they can deliver this kind of a number. Street was awaiting more clarity on what McKinsey's overall feedback, overall plan is. I think that's a 3-year overall plan. So we will await more clarity there. But in case of Dabur, clearly Campa Cola is impacting the fruit juice business. And on the Ayurvedic portfolio, I think they need to contemporize overall to the youth, etc. And from M&A perspective, also the way Marico has really changed the portfolio, I think a lot of the other consumer companies should take some learnings from there, that they have to grow around 20 to 30% of the portfolio at 20-30% to get a 6 to 7% volume growth. Otherwise, core part of FMCG cannot grow at that number. I think Marico, that's why is something which we really like in the staple space. We also like Britannia, Nestle, we like the liquor companies, and we like definitely Pilite also.
Take that point, 30% of your business has to grow around 20 to 30%. That's something that Pilite has been doing fairly well with their pioneer and growth categories. We've seen that with Marico, the digital and foods portfolio. Also, Tata Consumer has that, Sampann, Soulful and Nourishco portfolio along with Capital Foods that has been projected to grow at 30%. On Dabur itself, I wanted to ask you, Abneesh, I remember, I'm sure when you started tracking the sector, Dabur was compared at par with HUL when it came to looking at consumer sentiment and being leaders in the sector. Thereafter, it started being looked at par with, say, something like a Marico and Godrej Consumer. Now, after the derating that we've seen on Dabur's multiples, the earnings disappointment, a lot on the street believe that maybe it could be put in the bucket of, say, something like an Imami or Bajaj Consumer. What does Dabur have to do for things to change for them and the street to look at it once again favorably, because it's been a structural decline over the last few years?
So I think some parts of the problem is because of competition. So if you see, fruit juice was a key growth driver for them. And there we have seen the entire beverage companies suffer from that. So Nourishco of Tata Consumer suffered, and then they took the corrective action wherein they increased the trade spends, trade commissions, and now they are back to growth. In case of Dabur also, I think they need to do something on the trade spend. They need to do something on the 10 rupee. More aggression is required. So that part of the portfolio for Dabur is suffering. In terms of the healthcare, if you see post-COVID, the base became an issue. And my sense is contemporarization is needed. From a D2C perspective, I think there is the opportunity for Dabur, and Dabur yesterday said that they are on the lookout for that. So So I would say the portfolio is quite diversified. It's a much larger company than some of the companies which you mentioned. So I would expect them to come back, and McKinsey giving consulting, I think that's a positive. In FMCG, we have always seen Bain and all these consulting companies. When they give out the blueprint, I think there's a better chance that the management will have new data points, new strategies. So I would not write off Dabur. Yeah, it has been a challenging last 1-2 years, but part of it is competition, part of it is portfolio issue also, and they need to do much more D2C M&A in my view.
Okay, all right. United Breweries also came out with its numbers, Abneesh. The premium volume growth looked very good for the company this time, in line with the expectations of 24 to 25%. Your overall reading on the numbers?
I think we are quite positive on the company. In Q1, you will see extremely strong numbers for the company. The heat wave will help. The base is quite soft because last year, if you remember, the elections had severe restrictions for United Breweries and the beer companies in general. Third, of course, is Telangana. We have got a very good price hike after 4 years. So we will see multiple levers for growth in Q1 and FY26. The new MD who has come from PNG, he is doing a lot of structural improvement. He's engaging with the government to have a win-win kind of a policy. In Rajasthan, for example, there's a 20% increase in the capacity, which will help in the peak season of summer. In Karnataka, although there is a tax hike for beer, what companies is using it as a blessing in disguise. So they're pushing more of the premium portfolio, and that's why my sense is the margins in FY26 will improve because of Telangana price hike, and even in Karnataka, the premium portfolio will now grow faster. So we are quite positive on that company.
It's very interesting that they are using the Karnataka tax hike as a blessing in disguise. Speaking about blessings in disguise, this one is not in disguise, but the UKFDA that has been signed with India, that should work as a margin positive for a lot of these liquor companies, right?
Yeah, I would expect that. So UKFDA, if you see, last 3 years it was happening, and it was a waiting game. Finally, it has happened. Now we wait for the formal notification as to from when this will be effective. Yesterday, Radico Khaitan in the call said that they don't expect too much of a price cut to end customer because these are the premium part of the portfolio. My sense is some price cuts will happen. It's a competitive market. Suddenly, if your raw material, the duty reduces from 150% to 75%, obviously there will be some kind of a price cut to the customer, which will lead to better affordability and more volumes, and some part of the margin expansion will happen. So yes, my sense is this is a high single-digit kind of a portfolio contribution for United Spirits. So there we will see better volumes and maybe better operating leverage also. Overall, it's quite positive for all spirits companies because most of the spirit companies do import scotch, and that will become cheaper. The risk here is some of the state government might see this as an opportunity and might increase the taxes. And second is if all companies fully pass it to end customer, then it will be more of a volume uptick rather than a margin gross margin uptick. But operating leverage will still lead to EBITDA margin uptick in that scenario.
Okay, we're going to swing back to the entire urban consumption story. And I'm going to quickly, Abneesh, ask you about your view on Godrej Consumer's numbers.
So Godrej Consumer, if you see currently from a 1-2 quarters perspective, my sense is margin pressure will continue because although palm oil has seen a good correction, PFAD, which is the raw material in soaps, that hasn't seen much of a correction. So that is one nuance we have to wait for, and that's why 1 or 2 quarters of margin pressure will sustain. Second, of course, is in Indonesia, there is a disruptive player in air freshener, and that's why Indonesia margins could be slightly challenging. Now, on the positive side, we have a buy on the company from a longer-term perspective, but from a near-term perspective, we'll prefer Marico. The key drivers will be clearly in HI. They have seen initial signs that the new formulation is working. But my sense is Q1, because of the heat wave, you may not see that improvement. But after that, the improvement in HI should happen. They have given a guidance of around 7% kind of a volume growth in FY26 on that number. In terms of the Fab detergent, 250 crore kind of ARR doing extremely well. We expect that to double in FY26 and possibly next year should also further be improvement on that. In terms of the air freshener, again, they're trying a lot of innovative, a lot of disruptive pricing there. Deodorant also, which is very tough category in our view. Again, disruptive pricing and more of a pull kind of strategy is being done. So currently, 1 or 2 quarters of still, I think, challenge is there. But medium long term, I think Godrej Consumer needs an answer to HUL's disruption in the soaps formulation. Because even if palm oil corrects, PFAD corrects, I think HUL will still have that advantage that 20-25% lower palm oil is used in Dabur. Yeah, so that's the
Take that point. Abneesh, for the first time, I think we've spoken for so long and not mentioned HUL. That's the that's the kind of conversation that's how conversations have shifted in the consumer space. Just a final question before we let you go. We've spoken about reviews so far. We've spoken about management commentaries so far. What are your expectations from Titan, Britannia, as well as, you have Pilite reporting their numbers. You like Pilite. Asian Paints, the biggest of them all, reporting numbers. It's been a challenging 3 quarters for them as well. What are your expectations from these 4?
So out of these 4, I think Asian Paints will be weak. We have highlighted that it's a much more urban-focused company. So currently, Berger will be growing faster because Berger is more of a central India, eastern India, small town India salience. But in big towns, clearly slowdown is impacting Asian Paints. And that will lead to sales being slow, operating deleverage, EBITDA will be a miss versus expectation. That is our sense on Asian Paints, weak numbers. Of course, analyst meet is there post-market, so we'll have more clarity on the outlook. But from a raw material scenario, I think clearly paint companies are in a sweet spot from a FY26 perspective. Coming to Titan, if you see already the update is out, so we don't expect too much of a surprise there, except margins, where I think clearly we will see that there's a down trading and overall competitive intensity, which remains quite high. Britannia, my sense is margins will be a bit weak, but FY26, wheat crop is looking good. So I think Britannia, FY26 could be a good year. We are positive on the company. So these are the 3 ones. Pidilite, always a compounding story, and we continue to now see how the leadership style changes from to Sudhanshu Vats from Mr. Bharat Puri. I think that's a great company, and that remains a top buy for us.
Take that point, Abneesh. Thank you so much. Always a pleasure speaking with you. Wish to have longer conversations about deeper issues in the consumption sector beyond just individual stocks with you at some point as well. With that, we'll take a short break. Come back on the other side. We'll bunch up all the stocks which are in the news today.
Welcome back. Well, definitely a good day for specific stocks such as Niva Bupa, which is reacting to its numbers. So that stock is up around 11% at this point in time. Good amount of volumes traded on that one as well. Separately, we have Concord Biotech, which is doing well. That stock has shot up around 8%. And just watch out for Newland Labs. It comes out with its numbers on the 15th of May. So that stock is gaining some amount of traction. So up around 7.5% for that particular counter. Overall, that's what's taking place. A lot of these smaller pharma stocks seem to be gaining at this point in time. But one of the biggest stocks that we're tracking today and is a Nifty stock is Tata Motors, which is up in trade today on the back of a New York Times report that said that the US is likely to announce a trade deal with the UK. Sudarshan is here with more details on how this could impact Tata Motors.
So New York Times has reported after US President Donald Trump has put out on its social media handle on Truth Social that he would be announcing a trade deal with one of the friendly nations. And after that, New York Times has reported that it would be deal between US and UK. Also, the report mentions that details are not out as yet. We'll have to see if both the countries sign the deal or they put out a framework for the agreement and later on they might announce the deal. But if it happens, why this will be positive for Tata Motors? Because North America forms nearly 1/3 of JLR's total volumes, and also JLR contributes almost 70% to Tata Motors' consolidated revenue. And if this deal happens, it would help JLR maintain its the guided range of the margin, and going forward, it would be taken positively even for other Tata names like Tata Tech, Tata Elxsi. So we'll have to see how it pans out today evening or going forward.
Right. Thanks a lot for that, Sudarshan. Let's talk about Niva Bupa. That is another stock which is up and about in today's trading session. Reported a better than expected performance for the fourth quarter. Vamakshi joins in, 11% higher on Niva Bupa today, Vamakshi.
Well, absolutely, Mangalam. Good set of numbers coming in from the company, much better than what the street was penciling in. Of course, the net earned premium saw an uptick of almost 25%, coming in at 1,530 odd crores. The loss ratio has gone up by almost 580 basis points to 56.4%. The expense ratio, including the commission, was at 36.4%, with a year-on-year improvement of almost 50 basis points in the commission ratio and 190 basis points in the expense ratio. Resultantly, when we look at the combined ratio, that is seeing an uptick of almost 338 basis points. But despite that, this has come in much better than what the street was penciling in. The net profit is up nearly 31%, coming in at 206 crores. We also have a note from Motilal Oswal, and they say that strong underwriting performance boosted the company's PAT. Given the kind of strong performance that the company has seen in the fourth quarter, they've gone ahead and revised their estimates upwards, especially on the GAAP accounting standards. They believe that the company is well positioned to harness growth opportunities with a strategic global partner, a growing customer base, and innovative product offerings. They also believe that the company is taking measures to mitigate claim inflation, and this in turn will continue to aid their loss ratios. And apart from that, when we look at the operational efficiency, that too will lead to an improved expense ratio going forward. So they appear to be quite bullish and happy with the kind of performance that Niva Bupa has posted this time around. They have a buy rating, target price of 100. Resultantly, the stock is surging higher today.
Okay, yes, absolutely. Stock is doing very well today, Vamakshi. Thanks very much for that. Back to numbers. L&T is reporting its Q4 numbers today. Vivek is here to tell us what we can expect from this company.
Well, that's right. So capital goods major, infra major, L&T will declare its Q4 results today, FY results today. And remember, all eyes will be number one on the guidance that the company gives as far as FY26 is concerned. We are going to be coming off a very strong base as far as FY25 is concerned, especially when it comes to the order inflow outlook. Remember, oil prices are significantly lower. So what is it that the company sees in terms of order prospect pipeline is something that the street will look out for. Also, any improvement in core margins is something that we would watch out for. Looking at the numbers themselves, revenue seen higher by almost 16% on a year-on-year basis. EBITDA seen higher by 15.5%. Margin seen flat, and profitability seen higher by close to 14%. What is it that was the key development as far as Q4 was concerned? Remember, we had reported earlier that the company had emerged as the L1 or the lowest bidder for a project worth almost $4.5 billion, and this was from Qatar Energy LNG. And this particular order, if the company recognizes it in Q4, what it means is that the company will significantly and comfortably outsurpass its own 10% order inflow guidance for FY25. The ask in any case was quite muted given the fact that Q3 was very strong. End of Q3, the company had maintained all of the guidance parameters. Remember, 15% top line growth, 10% order inflow growth, and also had maintained the core margin guidance of close to 8.2%. And this is something that the street will watch out for, whether the company can go ahead and achieve this, given the fact that the company actually has a significantly steep ask rate for Q4. All in all, expect a top line beat, expect order inflow beat, but guidance on FY26, especially in terms of margins and order inflow, is something that the street will watch out for very closely.
Take that point, Vivek. Thank you so much for that. With that, we'll wrap up on our coverage of the equity market. Stay tuned. On the other side, Manisha Gupta joins in with Sabyasachi Ray, the Executive Director at Gems and Jewelry Export Promotion Council.
Welcome back, and joining us on the show now is Sabyasachi Ray. He's Executive Director at the Gems and Jewelry Export Promotion Council. Mr. Ray, hi, thank you so much for joining in. First of all, on the FTA that has happened with the UK, what does it really mean for the Indian jewelry markets?
Manisha, and one thing, of course, as you have seen that recently this India-UK deal has been signed. I will just tell you the volume of the business between India and UK. So we import $2.6 billion of, let's say, gold, silver, platinum, and we export around 941 million, around $1 billion of jewelry and the molten silver and etc., and gemstone and diamonds, finished diamonds. So if you look at this sector, we import the raw materials and we export the finished goods. So that way, this FTA will go a long way into seeing that we get a very good foothold into the UK market. Now, if you look at the duty part of it, of course, it ranges from 2 to 4%. I know a lot of people think that only 2%, how will it help? But in jewelry, 2% is huge, So that way it will have a price advantage. And UK is a very good jewelry market. They import some $3 billion worth of jewelry. I'm talking only about jewelry. Of that, we are only exporting some 400 million worth of jewelry. So we are around 15%. So what we are looking at is that at least with this FTA, with signing of the FTA, it will take some time to implement. After that, within a year, I think we are looking at some $1 billion. So at least doubling this exports is whatever we are looking. And of course, the trade also can double if we have not seen the fine print. If there are some advantages given to the imports of silver and etc., because we primarily import silver from there, then the trade will also improve. And if that is there, then the trade will also double. So that is around $7 billion. So we have everything to gain with this FTA. That much I can tell you.
Mr. Ray, if we look at the history of FTAs and the one that happened with UAE as well, we did see a lot of growth coming in. Would you say that this really is an era of bilateral trades, FTAs, and that is what the industry will thrive on?
See, one of the things, Manisha, what our minister also keeps on telling, and you also keep on, covering that, is that now the FTAs, whatever is happening, when you look at UAE, when you look at Australia, or you look at us, this UK, so and our goods, we are looking at consuming markets. These are the countries where you can buy jewelry, a lot of jewelry buying culture is there, a lot of jewelry demand is there. So that way, if you look at our sector, the FTAs, what is happening now, of course, is very, very beneficial for our sector. And of course, we are looking at future FTAs like EU or, in that sense, the USA BTA. If all these things take place, we have a very, very rosy time ahead.
Well, EU is something that we'll keep for later on, but the US FTAs, I do understand that the GAPC has made a lot of representations into it. Is there anything that you are in sense of conversations or updates that you're hearing from that one?
Yes, Manisha, in your channel only we have explained your viewers that in jewelry, you do not talk about percentage. Like today, every day you are, covering this commodity gold. So if you look at the gold, if 1%, yesterday only we are calculating 1% relief in import duty of gold means around, if it is 100 tons, it is 1,500 crores or 1,000 crores. And if it's 200 tons, 2,000 crores. So this percentage, I am just breaking it down for your viewer that how much it matters, percentage. So if in US the percentage 10% or 26%, whatever is being talked about in the reciprocal tariffs, this will be a huge blow to the industry if it remains like this. So we are very hopeful that BTA will give us some leverage there. And as we have always argued, and we are arguing with our government, and I understand they have also argued with the US government that diamonds are raw material for the US jewelry manufacturing industry also. So if they want their manufacturing to grow, that is one segment they should not tax. And we are very, very hopeful that, of course, at least the diamond gemstones and lab-grown diamonds, all these, the finished cut and polished, these stones will not attract any duty. We are also working on jewelry. We have given the government the threshold that anything more than 10% import duty, now it is 6%, will be very, very harmful for the segment, because the jewelry exports also is growing very, very robustly. If you have seen now, we are constituting around 20 to 25% of total jewelry imports in US. So that way, we are looking very hopefully, because what we understand that everybody, including their Treasury Secretary is telling that within a month with India, they'll be signing. And if it signs and if our sector is within that, and if whatever we have called to the government, if it happens, it's at least after this UK, there's a bonanza for us.
All right. I also want to talk to you about the month of April, where we've seen stronger numbers come in sense of exports, the diamond jewelry exports, that is. Do you see it sustaining, and how would you analyze those numbers? What countries, and how has the month of April been? Because the first quarter was not so great, but the second quarter at least has started well.
Yes, as we have told you that, we were recovering very well in the second quarter. Then this US tariff came. And you have seen, I think, again, you have only reported, and we have also, informed you that the first 4 days of April, there is huge exports have happened to US because of this tariff thing. And we understand that the type of exports also happened. So in April, you should divide into 1 to 4th April and then rest of April.
Okay.
So that way, of course, April has shown good numbers, but what we understand is that these numbers are due to this US tariff. But if something does not happen, we are not very hopeful, because US nothing is moving now. Nobody is importing, not only India, nowhere in the world, because in the US also the retailers and jewelers are waiting and watching that where ultimately this tariff will land, because the US is negotiating with so many countries. So they are waiting because they do not want to put in their money and then they will not get back those money. So whatever they've imported, I do not think that US a lot of imports are now happening. So May will not be good if a decision will not come from US. So that much I can tell you, that if the decision is not there, May will not be good.
Oh.
Okay, all right, Manisha. Thanks very much for joining in and taking us through that conversation. Well, with that, it's also a wrap on Halftime Report. Business Lunch will take all the action ahead.